My name is Ayush, and today I want to discuss about a pressing macroeconomic challenge that India is facing right now: the rapid and continuing depreciation of Indian rupee. As of late March 2026, the rupee has breached its 94 rupee mark, another fresh record low. Why is this issue important? Why are we discussing this? Because a depreciating currency isn't just a number on a trading terminal, but it acts as a direct tax on Indian consumers. Because India imports over 80% of its crude oil, with the West Asia conflicts going on, the crude oil has passed $100 per barrel. A weaker rupee makes this import exponentially more and more expensive, and this dual blow import inflation into our domestic market widens our current account deficit and it halts our economic growth. So to put that into perspective, if we go back to early 2000s, it took over 2100 working days for the rupee to depreciate from 45 to 50 against US dollar. In stark contrast, a recent fall from 90 to 94 merely took just 60 days. And the pace of this volatility is alarming and currently being driven by foreign institutional investors outflow and rebounding US dollar index, because the FIIs are continuously withdrawing, and we have seen the Nifty has come down to 22,000 mark. So what are the measures can be taken to stabilize this? If we talk about an immediate measure, there should be a tactical intervention by Reserve Bank of India. The central bank can continue to strategically sell off their dollars from their reserves to make stabilize the market and to prevent the panic-driven free falls. In the short term, if we say as a depreciating rupee, it also come up with some benefit because the exports have become now cheaper. The exporters have now incentive to export more and more. And if we talk about in the medium term, in 1 year span of time, we need to ease the foreign direct investment and foreign portfolio investments norm to attract a sticky foreign capitals to help the offset the current waves. But there are barriers to it. Executing these solutions present a significant barriers. First, the RBI cannot artificially just prop up the rupee forever, aggressively selling dollars, because if RBI is continuously selling dollars, the reserves will fall down and it will leave us vulnerable to future economic shocks. Secondly, the global headwinds are actively working against us, with US bond yield rising past 4.4%. As the bond rates are higher in the US, it makes no sense for FIIs to continuously invest in our market. This make it incredibly hard for foreign investments. Regardless of domestic policy talks, finally, any gain we make into export competitiveness are currently being heavily negated by the inelastic high cost of our energy imports. We need to focus heavily on exports, but there are very high prices we are paying for a crude oil because of the West Asia conflict. The rupee is continuously declining. The foreign investors are continuously withdrawing their money from the market, and Nifty is hitting record low. In conclusion, if we need to say, the rupee's ongoing depreciation is a complete interplay of global geopolitics, rising energy costs, and shifting of capital flows. Managing it requires a delicate balancing act between utilizing reserves. The RBI needs to utilize their foreign reserves in a way such that they stabilize the panic, also maintaining their reserve to a certain level to protect us from any future economic shocks. Thank you.